Good morning. Welcome to Good to Know Talk series, where our focus here is to provide financial strategies and tax tips to help grow your business and save on taxes. We understand that business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janean Kong, and owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. With us this morning, we have James Kaw. James is a financial advisor at Edward Jones. He works with small businesses, individuals, and families to identify their risk and develop strategies to help them reach their short, mid, and long-term goals. And he's my trusted source in the industry. Good morning, James.
Morning, Janine. How are you?
I'm good. I'm really excited about today's topic. I get asked often about tax deferral and strategies specific to real estate. So I'm really excited to to learn about 1031 exchanges and a lot of the details about it.
Yeah, and oftentimes it comes up in conversations as I'm sitting down with my clients as well, just to kind of better diversify their portfolio. So I'm excited to have James on the call with us today. So just to give you a little bit of background information about James, he's been in the industry for about 16 years now. Started off his real estate career in appraising in 2002. He began selling real estate in 2004. And then just in about 6 years, as being a realtor, he became partner of Locations Hawaii. So that was in 2010 when James became a partner. Outside of work, activities that he likes to enjoy are surfing, spearfishing, travel, church, and then hanging out with his family and friends. Really enjoys, and this is part of the reason why James is a trusted resource for my clients, is that he enjoys the education aspect of the job, and then 30 to 40% of his business are with first-time home buyers. So, James, if you want to unmute yourself, and then we'll let you take it from here.
Thanks, James. Thanks, Janine. Can you guys hear me okay?
Yep, we can hear you.
Okay, cool. I apologize in advance. Just like that. Can you see my screen?
Yep, we can see it.
Okay, cool. So first time using this platform, but thanks for having me today, and for allowing me to share a little bit about a topic I'm actually very passionate about too, because I have a strong desire to educate people on saving money, making money. I wish this stuff was taught to me when I was in high school. And even just 10 years ago, 20 years ago, it would have been really, really beneficial to me. So the topic today that I wanted to discuss was something to do with investment properties, real estate investment properties. And actually, this technically can pertain to non-real estate things too, because it's an IRS tax code, which Janine would really know a lot about. So please, ask the very, very specific questions with a very qualified tax planner like Janine, of course. But from the real estate side, where we find it very useful in the residential real estate world is helping investor clients grow wealth. And so I'll get started with these slides here. Just give me 1 second. Okay, so the tax code is very complicated, as you guys know. Janine can tell you. I want to talk about 1031 exchange. A 1031 exchange has other kinds of names. One of the synonyms for it is called the Starker exchange. Really, what it is it's a method for investors to sell property and not have to put it bluntly, not have to pay, taxes or gains, or taxes on their gains, taxes on their profits. As you can see on the slide here, I've capitalized defer. So that's a very key thing. You're not avoiding taxes forever, you're just deferring it. And so that you can put the most back sort of into your investment portfolio and into your pocket. So I'll explain a little bit of what that means. So to put it practically, let's say you own a 1-bedroom condo, or you own a couple of single-family homes, or maybe even own a warehouse space or a huge apartment building, and you want to sell it, but you don't want to pay the taxes on the profits because maybe you're one of the fortunate people who purchased in the early 2000s, or if you're a baby boomer, you purchased these properties back in the 80s and you just have made a ton of money on it. If you're trying to cash out to use the money for other purposes, then okay, yeah, you're gonna sell, and like anything else, Uncle Sam's gonna get his hands on it. But if you're trying to improve your portfolio or do something else with it, you want to think about a 1031 exchange. Now, what you do in this is you're actually taking the profit, or you're taking what you sell, and you're rolling it into another type of property. That's the whole idea of a 1031 exchange. And when you do that, you don't have to pay taxes on the gains. And there are a few rules that sort of spell this out on this next slide. So the 4 main rules for this type of exchange is you have to, whatever you sell has to be pretty similar to what you buy. So that means like kind. Without getting too much into detail, this rule is actually quite flexible. So if you're just thinking real estate for real estate, you're generally pretty okay. Okay, so since our whole topic is about real estate today, we're going to assume that you're going to be selling a real estate property and you're buying a real estate property. You can sell a residential property and then you can buy office space. That's like kind. That's just fine, and vice versa. The second rule is that it cannot be your primary residence. It can't be the place you're living in. It can't even really be like a second home. And that's why I have 2 asterisks there. It gets a little bit blurry when you're talking about second homes, but for the purposes of today, we're just going to pretend or just assume that these are purely investment properties, that you have a renter in there. We have tenants in there, you're collecting income. So if you sell this investment property, you can go and you roll it into another investment property. You cannot sell an investment property and roll it into something that you're going to live in, nor can you sell your home that you live in and roll it into an investment property. That would not qualify for a 1031 exchange. Now I want to kind of sidebar right here after this rule too. If you live in your property now, if it's your primary residence, there are substantial amounts of tax shelters. I mean, you don't have to pay taxes on a lot of gains if you're going to sell your primary residence. So you're not, don't worry. If you're selling your primary residence, there are ways to get around it. So don't worry. But if you're talking about pure investments, the only way you can get away from paying taxes when you sell that property is if you roll it into another one via 1031 exchange. Okay, rule number 3, the property that you purchase has to be equal to or greater in value. If you sell a $100,000 property, you have to purchase a total of $100,000 or more. If you sell a $500,000 property, you have to purchase something equal to or greater than $500,000. If you purchase something less than what you've sold your existing property for, that would result in sort of what we're mentioning in rule number 4, which is gains, right? So if you sell something for 400,000 and you try to roll it into something for 350,000, that $50,000, to put it very bluntly, is potentially taxable. There are a lot of there are ways with investments you can take depreciation and then your numbers change. So it's not all straight math like we're going to talk about today, but I'm just trying to paint a very simple picture today. So anyway, so if you sell 400,000 and you purchase something for 350, that $50,000 is called your boot. That's what they call a boot. So that technically is sort of that 50 grand is not going to be qualified for that 1031 exchange. Moving on to the next slide. Some interesting notes with all those rules is that the number of properties don't need to be the same. Meaning, if you sell one property, you don't have to just buy one. If you sell 2 properties, you don't have to buy 2. What's most important is the total dollar value of the rule, meaning as long as what you're purchasing totals to the same as what you sold for or is greater than what you sold for, it's fine. So you could sell $1 million property and then you could buy 4 $250,000 properties. Or you can sell, you can sell 4 $250,000 properties and then roll it into one $1 million property. So that still qualifies. Another interesting note that I thought I'd mention is that you can mix the types of properties. So like I said earlier, you can go from commercial, residential, industrial. So, we're talking real estate here. I read somewhere that I read some mention someplace about like farm equipment. So I guess you could do 1031 exchanges with equipment and things like that, but that's not my arena. So again, we're just assuming we're talking about real estate here. The third bullet, this is not a state rule. This is not a state of Hawaii rule. This is a United States rule. So you can do 1031 exchanges across state borders. So a lot of us here in Hawaii have a love for Las Vegas. So maybe you want to sell something here and then buy a couple of properties in Vegas because Vegas is so cheap. So you could do that and rent the properties out in Vegas. So there are no rules against that. And then lastly, the last bullet, as I kind of mentioned before, breaking the boot rule equals legal. That means legal. You can sell a property for 400,000 and then buy something for 350. That's not illegal, but you just have to be ready to pay taxes on that difference, on that boot, that 50 grand. So why would someone do that? Well, let's say I own a $500,000 property and I do need a cash out. I need to liquidate some of that, but I want to roll the majority of it into another property. So I'm trying to downsize my $500,000 investment into maybe a $400,000 investment. And then so I'm only going to be paying taxes on the 100,000, right? But then the difference of that 100,000 after taxes, I can use. That's my liquid money to do something. Now, something that I actually, forgive me, I failed to make very clear in these slides is that when I say gains, it means gains. So you have to be realizing gains. So if you're selling at a loss, then a 1031 exchange may be a moot point. I mean, you might not need to do a 1031 exchange because the whole purpose of a 1031 exchange is to protect your gains, to protect your profits. And the amount of gains in your profits will depend on how much depreciation you've taken, what your cost basis is. It gets a little more complicated, but that's where you work with your tax specialist like Janean. But again, we're just talking about gains, protecting your gains from taxes, deferring those taxes by rolling something that you sell into something equal or greater in value. I hope everybody's tracking it. But I wanted to include this slide. So, okay, well, why would I even want to do this, right? Let's say I'm perfectly happy. I've purchased something a while ago and I'm renting it out to somebody and I'm totally fine. It's out of sight, out of mind. I just have to, fix a few toilets here and there, or maybe I just report to a property manager. Why would you want to do this? Well, just like any kind of other financial asset that you have, like your stocks, your bonds, whatever James Kong might be managing, you always have to be updating your portfolio. You always want to make sure that you have strong pieces in your portfolio, and that includes real estate. So the first bullet there, maybe you started off with a 1960s one-bedroom condo. Maybe your father or your grandfather or something purchased something back then. They passed it on to you. You may want to think about rolling that into a newer property, a bigger property, and then eventually rolling that into maybe a 1995 built house. As you know, the older the property, the more problems you may have. A lot of the condos in Honolulu right now that were built in the 60s and 70s, they're going through a lot of large assessments where they're going through huge plumbing overhauls. The guts of the buildings are getting old. Condos are no different from cars, where you have to maintain them, you have to update them, and it costs money. And so it just depends on how well the condo's been run, how much money they have in their bank accounts and reserves. But as you know, a lot of condos and a lot of associations maybe have mismanaged, or there are a lot of unforeseen costs. And so you should always be thinking about going into something that is going to mitigate your costs and your risks. So upgrading. So that's one big reason why people think about doing 1031 exchanges. The second bullet, you just want to diversify your portfolio maybe. So maybe you have one property and you want to purchase two instead, because if one goes vacant, then you're only at risk for 50% of your portfolio, right? So let's say I have a house right now and I'm getting $3,000 of rent every month. If that tenant moves out or if something happens, I'm out $3,000 a month until I find somebody else. Whereas if I have two $250,000, two smaller properties that give me, I think was my number 3,000. If I have two properties that's giving me $1,500 rent each, one of the properties goes vacant, I still got the other tenant in the other property to save me from a full loss, right? So I actually have a client right now that is in the middle of doing this 1031 exchange, where they have an $800,000 condo and they're selling it. Actually, we close tomorrow, and we're going to go look at two smaller condos in Waikiki, where Waikiki has stronger rent. The rental amounts happen to be a little bit more inflated in Waikiki as compared to other places. And then also you have a high demand in Waikiki. And so they just felt like that would be improving and also diversifying their portfolio from moving from one to the other. And they're not spending any more money than what they sold for. They're selling for $800,000 and they're buying two $400,000 properties. So it's not costing them more money, but it is protecting them a lot more. Another way to diversify your portfolio, another reason is, I have a lot of friends with young kids now. They're thinking about, hey, what am I going to leave behind for my kids? Or I want to have one property per kid to pay for their expensive schooling. Private schools here in Hawaii are so expensive too now, right? So a lot of parents are doing that. So maybe I'm going to finally sell this one investment house I have, and then split it into two smaller ones, one for each kid, and then they just hold on to it forever. Whatever I sell that for down the line, whatever rental income I get for each property goes to that individual kid. So on and so forth. There could be a ton of different reasons. It's all very, very personal, of course, but these are some of the common ones that I've seen. This is my last slide, and I'm going to try to keep this really high level because the numbers sometimes get really confusing for people. So if you can try to track with me line by line. So let's say in 2003, I purchased a 1-bedroom investment, a condo in Honolulu for $150,000. And I tried to use real numbers here. I went back in history and I tried to look at actual numbers. So $150,000 cost. And I took out a $120,000 mortgage at 6% interest. So the total cash I put down on this was 30 grand when I purchased this. And that kind of equaled to about $1,000 per month in total costs when I added taxes, maintenance fees and whatever. And let's just say, for calculation purposes, to make it easy, the going rent at that time for that condo was also $1,000. So my monthly cash flow was zero. I was breaking even. That's great. I'm fine with breaking even. Now, 4 years later, ramp up in the real estate market. If I sell that same condo, then I could sell it for $325,000. Again, these are real numbers. These are properties I looked at, and this is actually how much it appreciated during that time. So now $325,000, my property has appreciated nicely. If you look at the purple, I've since then paid down my mortgage down to about $95,000, right? And so if I sell that same condo for $325,000, I'm walking away with a $230,000 profit. And so that's all taxable if I'm going to try walk away with that. And so instead of getting taxed on that, I do a 1031 exchange and I roll it into something else. But I want to improve my portfolio. I want to go bigger. I want to go better. And so in 2007, simultaneously, I go ahead and I purchase a house. So I move from a 1-bedroom condo, and then I go and purchase a house for $550,000 using that $230,000 profit. If you do the math, that means a larger mortgage of $320,000. Interestingly, the interest rates in 2003 and 2007 were pretty similar. They fluctuated, so it makes it nice and easy for my example. And let's say my total costs were $2,000 a month with this house, okay? So, if you pause there, you're thinking, well, James, you just increased your cost by $1,000 a month. Why would I want to do that? Well, if you go down to the second bullet of the very bottom, example there, a house of that size would be renting out for $2,000 a month. These are actual numbers. I went and looked at history. So my monthly cash flow is zero. I'm breaking even. So in 2007, I'm breaking even. In 2003, I'm breaking even. Except I have a much bigger, better property in 2007. And so these are the main benefits I derived from that. So the same cash flow, which is zero, I was trying to do a very simple cash flow analysis. But I have a bigger house, a bigger asset. I didn't have to pay profits on that $230,000 that I made from riding the market and also paying down my mortgage. And then the other thing too, which is a whole nother subject, is my $320,000 mortgage is a much bigger tax shelter than the $95,000 mortgage from that condo. So when you break it all down, it's a much more beneficial situation than just hanging on to that little condo. That maintenance fees will probably go up. You're going to start getting hit with plumbing assessments, elevator replacement, all that kind of stuff. So you always want to be thinking about improving your portfolio. So that hopefully gives you a pretty good picture of what a 1031 exchange can do for you. Again, there are a lot of different examples. It's a case-by-case situation. So what you want to do is, if you own something like this, you want to just sit down with a realtor, and then you sit down with an accountant to see what numbers you're talking about. And then that you just go from there. You let the professionals take it from there. And that's what I got for you guys.
Thanks, James. Yeah, you know what? If anyone has any detailed questions, you can always contact James. I'm just going to give them your email address, James, and that's going to be james@locationshawaii.com. So it's james.chan@locationshawaii.com. And so I know we're running close to time. So if you have any detailed questions or want to sit down with James to talk about real estate investment strategy, again, he's been in the industry, for over 14 years now, and very credible source. So thanks for your time, James. Janine, did you want to add anything?
Yeah, thanks, James. James, I just have a question. There's fairly strict rules in terms of the time, right, for 1031 exchanges. Can you talk a little bit about that in terms of, I guess, the process?
Yeah. Thanks for bringing that up. You don't have an infinite amount of time to figure out what you're going to buy once you sell something. So the rule is that basically have to close on your new property to qualify for this exchange within 6 months of selling your original property. So within 6 months, you have to purchase. You have to find something and purchase something else. There are other little dates within that time frame where you have to identify a list of properties that you must go for within 45 days and whatnot. But you basically have to close it within 6 months.
Mm. Okay. Yeah, thank you. Yeah, that's really good to know. And, like you mentioned, there are some tax benefits, but the calculation can get quite complicated. So if, anyone is interested in doing, this exchange, I'm happy to, sit with you to go over the numbers, so we'll know, if there is going to be any type of boot, what your tax is looking like. We can run some projections for you. But yeah, thank you again, James, for being with us. We are at the end of our time today. You can reach out to James if you have specific questions. You can also send us an email at info@smarttaxhawaii.com, and we'll get you in contact with James Chan. Thank you again, James Chan and James Call, and we look forward to next week, same time, same place. Have a great week, everybody.
Okay, thanks you too, Janine.